Okay, I think we can start. Uh, Hello, good evening, and welcome in Global Compounders webinar. In a recently published newsletter, GCP team has touched upon a very important topic of skin in the game. We at Marcellus put a lot of importance on it. In fact, if we look at the origins of Marcellus, one can clearly notice that the core team has full skin in the game. Core team left their stable job and set up Marcellus. Most of their lifetime savings and their immediate family's money is invested in Marcellus. From day one, Marcellus has ESOP plan to incentivize key talents and to remove principal agent problem. From investing perspective, our investment team tries to identify companies where there is no principal agent problem, and the founders and the owners are actively involved in operational and strategic decision making. To understand more on the topic and dig deeper, we have with us Arindam and Jaibir. Arindam, Jaibir, request you to help us understand more about it and help us understand the impact of management team's skin in the game on future stock performance.
Thanks, Nitesh. So in this webinar, I am dusting off my old hat and putting it on. Now I work on GCP, I work on global tech, but I spent over a decade looking at Indian stocks. One of the important lessons which any Indian investor will tell you about is how important the promoters of a company are. The expectation I had going into GCP was that this was an Indian phenomenon. The surprise for me was the outcome of the GCP portfolio, which has a very high share of owner operator or family run companies. So the same importance of promoters applies to GCP as well. So hence, I'm putting on my Indian hat and trying to understand that better from Arindam. So Arindam, starting with this, so what's your thought on what drives this? Why is this so important in the American context and in the global context?
Yeah, thanks, Jabir. You are right. And to be fair, if I look at the portfolio that we have now, we can say that 40 to 50% of the portfolio is allocated to companies which are actually run by families or the founders. Now, if I just open the kind of horizon a little bit more, like if I include the CEOs who have been long in a company, long means like 15, 20 years, and they have a real skin on the game, that allocation actually becomes even higher. So kind of 60, 70% of the portfolio. Now, we didn't start to construct the portfolio keeping in mind that we'll only be investing in owner operators, to be fair. But, if you think about the way we started constructing the portfolio, the filters that we have put in, that to some extent kind of, tells you that, that is where we eventually end up. Because remember, we are looking for companies that have been there for a long, long time. Like at least our, the age of the companies that we have in our portfolio, they're at least 25, 30 years old. There's the minimum age, right? Now we have this kind of companies, and these companies are supposed to, which we are looking at, they are supposed to deliver solid returns on capital, right? Over a business cycle, over 1 or 2 business cycles. And they have to deliver like, very long-term, free cash flow growth, revenue growth through cycle. Now, if you put these things together, it is very hard to imagine that, a subpar management team cannot really do it. Now, I'm talking about subpar management team, but historically, what I've seen is that there are exceptions. I mean, in developed world, the exceptions are actually, there are quite a few exceptions, like professional management run companies have also done very well, created a lot of value for the shareholders. But broadly, the thing that you mentioned, it is not an Indian phenomenon. In fact, we have seen papers, literatures written over owner operator, their long-term performance, etc. Now, before I go there, just to make sure we understand, like, even in our portfolio, how these companies look like. So you can see the statistics, the fundamental statistics of the companies that you have invested in. So if you look at this, the free cash flow per share CAGR or the EPS CAGR for these companies, you can see, like the 20-25% number that we talk about, they have actually delivered that. In fact, if I look at the broader portfolio and the CAGRs that you have for the broader portfolio, these owner-operator companies have actually delivered better. Okay. Now, talking about, why do you see this? So we see it everywhere. Okay. So the line that you see in the top, so this is actually a report, very interesting report. Credit Suisse publish it every year now. So what they try to do is they take the the family-run 1,000 businesses across the world, and interestingly, Asia represents the biggest cohort, China and India. Like Asia is kind of, as you said, more kind of promoter-driven, that kind of culture, right? But US also represent around 15 to 20%. The important thing is that whichever way you slice or dice the data, you just cut it by sectors, you cut it by geography, you cut it by region, any way you do, the point is the founder-led, the family-owned businesses tend to outperform the broader index by 400 basis points. Okay. Now, I came across actually one interesting, I would say, note, or actually kind of research paper back in 2014. So this just talked about how CEO compensation matters. So these guys, this is the finance, the Journal of Finance. It's a very well-respected body. So like it is not, you can just run back test on thousands of things, and you can come up with something that looks good. These guys don't do that. Now, these guys tend to do a lot of thorough back testing, checking for different anomalies, like you take out momentum, value, growth, etc., out of the picture, and they try to figure out that if there is anything left. Okay. The outcome of this paper is actually staggering. They figured out that on an average, 4 to 10% is the outperformance when the CEO incentive is actually tied to ownership of a company. Okay, so that is actually quite remarkable. Remember one thing, that these guys, like typically the researchers, they are actually a believer of efficient market hypothesis. So whenever they find anything, they tend to make sure that, they not make sure, I mean, you can actually justify using many regression analysis, etc. But typically, they don't give up on the fact that the market is efficient. So there is no inefficiency in the market in longer term, right? But in this case, I was happy to see that, they actually talked about, the thing that I've bolden out here, kind of in the quote, they actually acknowledge the fact that there is really something called incentive effect, where the CEO ownership and the stock market future performance actually matters quite a lot, right? And the acknowledgement is actually very interesting in the sense, as I said, like they don't typically agree with the inefficiency that exists in the market. Now, coming back to JB, your point, and Nitesh actually touched upon it earlier. The problem in running, in any enterprise is actually the principal agent problem. If you can solve that, most of your things are actually solved, right? So this is actually a kind of nice diagram that was put out by Horizon Kinetics. Actually, they run a owner mutual fund, owner operator mutual fund, something like that. But putting that aside, they have actually laid it out very nicely. So on the left, what you see is a company that is run by professional managers. Now, their driving force are very few, right? I mean, very clearly, they need to deliver the quarterly earnings. They have to make the Wall Street happy. And then their compensation is tied to the quarterly earnings. I mean, how they have delivered year over year. And also, the compensation is aligned to the fact that how big is the company in terms of revenue. Now, if you just do a deciling, simple deciling of S&P 500, take the 500 companies and decile the CEO compensation by the revenue, right? So the companies that are generating the highest revenue, their CEOs or the CXOs get paid the most. That's how it works. So there is a natural tendency to boost up revenue or empire building, if you can put it that way. So minority shareholder interest comes later, right? So this short-termism actually impacts the companies in longer term. So this actually ends up, companies acquiring wrong entities, that is not related to their own business. They're not fortifying their moat or etc., anything like that. Instead, they're just trying to make sure that their payout is larger. I'm just talking about the company space, company, just company basis. But if we just think through something like a China, right? So it is a good example in my view. So China's GDP, that increased by 12 to 13% CAGR over last 30 years. The stock market didn't make any money. Their their presence in MSCI emerging market, that increased manifold because the market cap increased, right? The companies got bigger, but the shareholders are not making any money because their managers were getting incentivized to make sure that the company goes bigger. There's no incentive to make sure that the minority shareholders are actually making money. And that is where the disconnect lies. Similarly, when you are looking at, a company that is run by, say, managed like the founders, or if the management has a lot of skin in the game, then they are actually trying to make sure that they become rich. And for that, your quarterly results, etc., really doesn't matter. And we have seen like numerous examples in in Western world. In fact, we have quite a few companies in our GCP portfolio where the management teams even don't actually publish. They don't host quarterly calls. They just think that there's a distraction or kind of a it's kind of a, I would say, cost takeout opportunity, because you don't need to employ and complete IR team to make sure that you're kind of serving your investors who are not actually willing to understand what you want to do, rather than they're just looking for quarterly numbers. Okay. Now,
So can you
yeah,
can you share a couple of examples which illustrate this alignment? Because this is what we've seen in India for decades.
right. No, absolutely.
But from your experience from the GCP portfolio, any particular names which demonstrate this?
Right. Yeah, definitely. We can actually talk about a couple of companies we have here. So one of the companies we like quite a bit, its name is Copart. So they are basically the largest online auction place for salvaged cars. So think about what is salvage cars. So basically, these are companies, if a car goes through an accident, for example, the insurers can kind of come and assess your value, right? So if the value that they assess, is actually higher than the cost to repair, they basically repair that. Otherwise, what they do is they just sell it to people, the dismantlers, who basically take out the parts and they can sell it to their buyers. So Copart is the largest salvage car auction company in the world. Okay. Now, the journey is actually quite remarkable. So this company started in 1972 by a gentleman called Willis Johnson. It started out of one scrapyard in Vallejo in California. Now, he understood one thing very clearly, that the sum of the parts of a car is actually have much more higher value than the whole car, right? That's the typical norm. That's how the aftermarket works. He understood that, and to make sure that he can actually make money out of it, he took actually quite a few steps in that process. So he was the first one who not only just dismantled the car parts. No, he not only just dismantled the cars, he also dismantled the parts of the car. So we didn't say for a mirror, there are several components that goes into a mirror. So we kind of dismantled that mirror to get different parts out of it, so that it can actually maximize the guy who is buying that. You can get more pointed service that this is what you want, and this guy can actually make higher margin. Okay, so this is one of his inventions. And then secondly, what he did is, like, he was the first guy actually who thought about taking this entire model to an online platform in 1998. Now, the reason I'm taking the timeline, because 1998, at that point of time, there are a lot of other companies in the online e-commerce side that was coming up. eBay came up in 1995, Amazon something around the same time, Paid.com. Basically, the e-commerce was starting to boom. And think about it, this guy, Willis Johnson, is a high school dropout, right? And this guy with no technology background, he came up with taking his entire business model to online. Okay. And right now, 100% of their business is done through online. That's the second thing. So these guys can, even though they don't have any professional kind of, educational background or something like that, but they are smart thinkers. They're original thinkers, and that is what matters. Number three, they had a competitor back then in they still have actually, that's called IAA. That is also a salvage car. They are also a similar business model. Now, IAA, after its initial days, it was actually run by first a PE company and eventually by professional managers. So IAA's model was very different from Copart. So what Copart used to do is they used to buy lands for the scrap yards, whereas IA used to lease those lands. They would not buy it. So again, from a professional manager standpoint, it actually makes sense because your initial cash outlay is lower, right? Your initial cash outlay is lower, so your ROA, ROIC numbers look pretty good because the asset is not sitting on your balance sheet. But for one thing that they missed out, which Copart understood pretty well, that the scrapyard has a big NIMBY effect. Now, what is NIMBY effect? If I explain that a bit, scrapyards are kind of a landfill equivalent in the car industry, right? So you don't really, it is important, but you really don't want it to be part of your locality. Okay. Now, once you get that, it is very hard to get a second scrapyard built nearby that locality. Okay. Now, what that means is that your land, which you bought for the scrapyard, actually gains enormous value over time. Now, when you're leasing that out, when your next lease renewal is coming up, say after 10 years or 5 years, your new lease rates are actually taking care of this appreciation in land price, right? Now, that is what is actually, that differentiated Copart versus IAA. Now, if you look at that, the return on invested capital, the top left chart, you can see the return on invested capital of Copart is actually twice that of IAA, right? And that is the power of long-term thought process, because you cannot buy a land, if you think about 20 years, what is going to happen. So that is the power of long-term compound, long-term thinking, and that's what exactly Copart did. And in the meantime, Copart's market share went from 20-25% in the salvage car to now it is 65%, right? And given that they continued to gain more and more market share, remember they run a marketplace. The marketplace is nothing but where the buyers and sellers come in. So when you have more and more cars, when you have a larger inventory, the buyer and seller pool also gets elevated, right? So that helps into the second level or more that they build over time. So point being, this smaller nitty-gritties that they did over time, that helped them, these guys, to compound an astounding 20-21% CAGR, both their EPS as well as the share price over time. So again, we just talked about Copart. Similar kind of thing, I can give you another example. What we have in our portfolio, the company's name is Old Dominion Freight Line. So they are basically a trucker. You buy a truck. So they started again in 1937. They used to run a single route in Virginia. So they are a trucker. And through 1950s in US, actually, there was a lot of consolidation that happened within the trucking community. People, basically companies, the little companies bought each other. It is a tremendously fragmented industry. Think about it. You can just buy a couple of trucks and you can get on the road. There's a simple business model. 1980s, US Motor Act came in. So that basically told that, we cannot really regulate the prices. It has to be more price competitive. Now, at that point of time, Congdon family, they took a very, very judicious decision, which shows up now. But that point of time, it was actually, if you think about it, it was actually very, very weird, because they chose not to participate in the traditional truckload market. So there are two types of truckload, if you think about it. So if you think of Walmart carries a lot of goods, right? So they own their full truck. So that is a pure truckload. You fill all the stuff with your own stuff, own things, right? What you need to ship. Less than truckload is for people where they don't have they don't have the goods that can fill up the entire truck, but they can buy a part of the truck capacity. That is what is less than truckload. Now, this is typically a harder model to run, because you have to collect, goods from different sources, like different places. You have to have these pickup trucks. You have to come to somewhere which you call service center or cross dock. You put all your stuff there. Then based on where each of the things has to be shipped, you kind of reallocate your resources. So you need this middle layer, which is a lot more capital intensive than just buying a truck. Okay, that needs like each of these, they might cost you tens of, 10, $20 million to reach each of these service centers. Now, the LTL market is way smaller. The less than truckload market is way smaller than the truckload market. So truckload market is around 15 to 16 times larger than the less than truckload market. So natural inclination is that, you go for the bigger market. But these guys didn't do that. They went for the less than truckload market. 40 years back, this was even much smaller. Now it is a $40 billion market, but it was probably much smaller than that 15 to 30, 40 years back. They went for that. They understood that the players operating in that market are actually not as efficient that they can be. So over the time, Old Dominion built its dominance in that LTL market. Even in 2002, they had a 2% market share. Now they have 14% market share. Okay, 7x the market share. And if you just look at the numbers, I mean, the staggering numbers, it is actually one of the best performing stocks in S&P 500 over the last 15, 20 years. Okay, a truckload company being one of the best performing stocks. So it's kind of, it tells you something, right? One thing that surprised, it'll probably surprise the typical, professional managers, is that in the bottom left, if you look at the capital expenditure to different points in the cycle, we've actually identified the times when there was recession. 2001, 2, 8, 9, 19, 20. Okay. Those are the times when the economy is in trouble. Old Dominion goes out and buy more capacity or build more service centers. Okay. So when everyone is scared, these guys deploy capital. Right. So that is how they manage their business. That is how they have grown for so long. And again, it's a core part of our GCP portfolio. But coming back to your point, Javid, so when you are thinking about this kind of companies, they do things a little bit differently. They're incentivized to do it that way. A professional manager would probably not do that.
So I'll point out an exception to you. So in India, Asian Paints demonstrates a lot of the behaviors that you talked about here. But they're also known as a CEO factory because they've got very capable professionals who actually run that company today. So are there, is that just, again, an Indian phenomenon, or do you see this kind of behavior in professionally run companies with no real founder or owner operator around?
Well, there are definitely quite a few exceptions there. But typically that comes with very long tenured CEOs. You'll find companies, like we have, for example, you talked about Asian Paints. Sherwin-Williams is a classic example. Sherwin always internally promote their people, so they don't have external CEOs ever actually. And each of their CEOs, if you look through, their background, they probably be a CEO for 15, 20, 25 years, right? Till they retire. One of the companies that we can probably talk about is what we have here is Amphenol. It's a GCP company that we have. Again, probably 100-year-old company, very rich history. But if you look at, there has been just, in 90 years of their operation, they're just having their fourth CEO who is running the company, right? So it is about, building the ethos, building the principles, the guardrails around which you want to run the company. The first guy was there for 35 years, as you can see here. But anyways, these guys have been doing it for 14, 15 years. And if you look at the right part of the chart, the consistency of their ROC or ROE, each of them are actually remarkable. And we don't have the history for even the long, like the previous year. But if you put it up, you would see that, that 15, 20% of ROE through each and every cycle, going back to 30, 40, 50 years. That is how they have been doing it. Again, the core ethos are there. The culturally, they make sure that, they are not overcharging people. So the pricing discipline is exemplary, right? So that you can see in the second chart. So those are the things, like it is the good thing about, this kind of construct is there is nothing written on the wall. People find their ways to work through it. what we try to do is we try to look for companies like this, where the CEO has been there for a long time. Because think about it, like this guy, for example, the guy who is running it, Adam Norwich, he has been there for 14 years, right? So over time, the amount of equity that he has built into the company, his cash compensation is actually very low compared to that. So in that sense, he has actually a lot of skin in the game, right? So that also works pretty well. And we look for that kind of companies as well.
Right. And any particular, like what specifically do we go looking for that these sorts of companies show up? Because if you do a straightforward, which is the fastest growing company, you won't find a lot of these names there. So what do we go looking for that you come up with names like this?
I mean, this is most of these companies you'll find that they are actually profitable. So they know the unit economics, understanding of good unit economics. That is actually key to all these owner operators if you see them, right? So for our filters, for example, we are looking for this consistency of return, right? That is nothing but unit economics. At the same time, we are looking for that to make sure that okay, you get good unit economics, but you have to scale the business up. So for that, what you look for the revenue growth, you look for the consistent free cash flow growth or CFO growth, right? So once you put together all these things, you get a fair bit of quantitative idea that this company might be a decent place to start. Now, there comes the second leg of our research that we do, right? So we have a lot of emphasis on the governance, right? I mean, we have to make sure that the behavior that you're looking for is actually enforced really well in the company structure, right? So, I mean, we spend a lot of time reading the proxies, talking to so many people in the value chain just to understand that, what they say, are they really doing that? And there is no shortcut to it. You spend a lot of time to understand like how really invested they are into what they're saying. And if they have a long tenure, long horizon in their own career, then there's a decent chance that they'll deliver on what they're saying. And at the same time, given that these companies have been there for a long time, so for example, this guy Adam Norwich, right? So he has seen already 2 crises, right? So these guys, you can rely on this fellow that he can actually navigate to the next one, right? So you're basically looking for resilience. You're looking for resilience, looking for frugality, looking for good capital allocation, right? And you also look for people who can empower other people, because you have to remember one thing, that these guys understand that they're super smart, but at the same time, they do understand that they cannot run the entire company by themselves. So you need to have a decentralized kind of operating system, and that has to flow through the entire org structure. So we spend a lot of time analyzing these things and put a picture together to make sure that the company that we're investing in actually makes sense. Like it can actually create value for minority shareholders.
The other question which often comes up is around succession, particularly when a company is going from has got a really charismatic founder who's built it up, run it, has a proven track record of execution. When you've got a company like that, how do you think about succession? What are the sorts of risks that you worry about, and how do you embed it into a decision?
Yeah, this is an absolutely fantastic question, Javid. So if you think through it, the way we constructed our portfolio, the scoring methodology for each of our companies, the qualitative scoring, we do have certain parameters, what you call them, specific risk. The specific risk basically tries to deal with the problem we just mentioned. You have a rockstar CEO. If he is leaving, what is the impact on the company, right? So if we think, through our due diligence, we understand that, this guy is actually phenomenal. He has built the business, but we don't see, someone beyond him who can actually drive the business. Then we tend to penalize them heavily in that specific risk category. And remember, the scoring that you do for this risk is actually multiplicative, right? So suppose a score of a business is 50, and we are not comfortable with their, the key man risk, right? So we tend to penalize it heavily to make sure that the position sizing in the portfolio is reflected there. So that is one way of handling that. Yeah, go ahead.
So, can you give any examples where we've had to do this, where there is a specific or the
Yes.
counter example of companies where we've done the work and gotten comfort on succession?
Right. So yeah, so we have, for example, we spoke about a company called Constellation Software. This is run by this founder called Mark Leonard. So he has been there since inception. It's a very decentralized organization, and we like the company. I mean, to the T. There is no doubt about that. But we do have some concern that he is actually a superstar. There is no doubt about that. So we tended to punish that company. Now, penalizing it in the key man risk. Now, talking about the companies which have actually done well. So we can do it in 2 ways. So let us talk about a company which went from a founder-led to a management-led, and then we'll do a company which has been still run by the family, and how that helps. So let's talk about Apple. I mean, Steve Jobs. We don't have to. We all know about his charisma, how good a leader he was, and how good an innovator he was actually. So when Tim Cook took over, I think it was somewhere in 2011, the apprehension, around Tim Cook's ability to deliver on Apple's, what Apple used to do was questioned. And it is actually quite ironic. I mean, so Tim Cook went to Duke University, and I also at that point of time was doing my MBA there. I could see even in the same alma mater, like where you have passed out, where you have kind of graduated, even there people are so apprehensive that, why Tim Cook? How could he run this kind of organization to greater heights? But incidentally, what it did over time is actually phenomenal, right? So one thing, I mean, when you think about R&D, for example, we always think about coming out with new products every now and then, right? That is our thought process of R&D, especially in the tech hardware space. But what Tim Cook did, I mean, you can see the R&D spending to sales over time. Tim Cook took it up to a kind of very high level that you can see here, and we couldn't see any product. So the apprehension was even getting higher that, you're spending all these dollars, where did they go actually? But now if you think about it, if you just think about the iPhone, right, and the chip that goes in and the power, the sophistication that it has, it is actually unmatched. No other phone in the world can match the efficiency of an iPhone chip. Now, think about the vision of this guy, right? He took this step of fortifying the moat of a specific device is actually unique in tech hardware, right? I mean, we have never seen that a tech hardware turning into a consumer staple kind of a product, right? You cannot really live without it. That is quite unique. And that is what Tim Cook did through his R&D capabilities, investing in that. He just fortified that moat. He made sure that there's a cost discipline all through the org, right? One unique thing, I mean, if you have noticed, in the last during the last year or so, many tech companies announced layoffs, etc. Apple barely did. Apple and Microsoft, both of them. The reason being that they are just disciplined all through. They never overhired during the entire boom. People are talking about everything is getting eaten by tech. They didn't kind of respond to that. As a result, they didn't have to respond when things are not going good for them, good for the industry actually. So, discipline around cost, discipline across innovation in a different way, and finally elevating a company from a tech hardware company to a kind of, consumer staple kind of company. That is actually phenomenal, and that drove Apple share price. If you look at the earnings multiple, it went up from 13, 14 times P to 25 to 30. That is what typically a multiple a Coca-Cola or a Pepsi gets, right? So that shift is genuinely sometimes get underappreciated, and it is despite him not being the founder, he could do that. He could accomplish that. So, to your point, he's an example where the founder left or he passed away then the second guy who came in, who kind of delivered on the promises that were made to the shareholders. Now, another example where a family is still being involved in the business is classic one is actually Armis. This is a sixth generation, right? This is a sixth generation that is running the business. And if you think about it, I mean, it is not that they had a very easy run through all this time. In fact, in 1970s or 80s, there was the synthetic leather, etc., that came in that impacted their business quite a bit. It was very hard for anyone at that point of time. Armis was losing market share, but again, the family came in and said that this is what we want to focus on. This is our bread and butter. We can think about newer designs, but we are not going to give up our legacy. What we do best. Now think about, like, if there is a professional manager, the typical response would have been that, okay, everyone is doing synthetic leather, let's go and do that, right? But when you have this kind of family ownership that is controlling, controlling the company, and they're actually trying to build wealth for their grandkids. It is not that they're trying to build the wealth for themselves. They don't need it, right? So the thought process is actually completely different. You can see that even now, right? So even now, Armis is not aiming to grow their volume like the bags, not more than 6-7% in volume term. That's what they want to do. They have demand to grow where they can grow at 15 to 20%, but they don't, right? And that is where the control of the family that comes in. They make sure they understand the value of the business is keeping in the scarcity that it brings in. So at no point of time, because of short-term profits, you can let that go, right? If you think about it, there is the chart that you have in left bottom. So since 2010, the number of store count has actually come down. Now, if you think about a kind of regular professional manager, and you know that your product has a huge demand, what do? I mean, you take up your store count, right? But here they don't do. That is because they want to keep their core values intact, right? And that the result is kind of, you can see on the right hand side of it, the EPS compounding of 10, 15, 20% over this time frame, as well as the share price compounding following that, right? So the point here is that there is no set rules. Everything can work, but you have to understand the construct, like why something is working and why something might not work, right? So once we can do that reasonably well, then there is a lot of scope for value creation.
Is this construct of owner-operated companies doing better, is that well appreciated by the market? Like, is there any mispricing there?
So if you think about the valuation, right, so there are two components of it. One is the growth, the near-term growth rate, or what you can project basically 5, 10, 15 years. And the second thing is longevity. And when you're thinking about these companies, it's mostly around longevity, because they are, again, managing the money for their next generation or the generations to come. So longevity for businesses are huge. So one way that you can, try to establish that, if it is getting appreciated or not, is something that I look at is like, what is the simplistic way of doing it, based on the GCP holdings that we have in our portfolio, or how the relative PE means related to the market, how the PE has changed over last 10 years, right? So if you see, I mean, the relative PE has remained constant over this time frame. Of course, they trade at a premium, and they should trade at a premium because the longevity, the growth that they get through. But point is that even in last 10 years, they are trading at a similar premium on a weighted average basis or an average basis that they used to do 10 years back. So to me, that is an opportunity. So I mean, that's an opportunity. So I would say that, it has not been well explored yet in that sense. The longevity is still underappreciated quite a bit.
Thanks, Arindam. Those are the questions I had on the owner-operator piece. I think you have a portfolio update you wanted to share.
Jabir, I have. This is pretty fascinating. So I had one query, Arindam, if you can answer. In today's era of PVC backed firms, how do you differentiate operator construct compared to VC backed startup ecosystem?
Yeah, that is actually very interesting. So, look, I mean, the good companies, the good VC-backed companies, they tend to start making money quite early. I mean, I'll say in third, fourth, fifth years of their operation in some way. I mean, I have a chart for actually Amazon here. I can pull it up. So if you think about it here, it is the Amazon's like CFO to invested capital. Okay. Within 2002, 2003, I mean, they were actually making money over, hand over fist, 42%. Right? So the business model was very unique at that point of time. So you're online e-commerce, right? So you're basically getting money even before the good has been shipped or even in your inventory, right? So you have this negative cash flow cycle, you're getting money much earlier than, than you would have got. So that helped the business model scale quite a bit. Even in case of Google, you will see that they started to become profitable quite early in their, in their journey. Now, in our framework, it typically takes a little bit longer to get this company screened in. So, for example, in our framework, we'll not catch an Amazon in 2003. We'll probably catch an Amazon in 2007, 8, 9, that time frame. And we're actually perfectly okay with it, Nitesh. Because if you look at the journey of these companies, if you think about it, go back to 1999. There are so many e-commerce companies that came in. For every Amazon, I mean, there was a pet.com, Worldline. I mean, there's numerous number of companies, right, who are having the similar characteristics of what you were saying between the year 1996 to 2000. Same characteristics, right? Now, how do you know the probabilistically you're not in a good shape to pick up the right one in most of the cases? And given that we are managing clients' money, we don't want to take that risk. So we're happy to let them run for some time, say 5 to 10 years. When they build that history, we're happy to participate in those. In the current construct, we do, like given that we have seen some phenomenally successful companies like Amazon, Google, etc., we sometimes feel that some of the valuations around the startups are something that quite a bit punchy than we can actually digest. As I said, like when time comes, when we feel that the companies are reasonably profitable to our palate, we'll definitely go for those. But again, the owner-operator construct doesn't really change. The best owner-operators, they will make sure that their companies become profitable in real terms, not on paper.
Got it. Makes sense.
Okay. Let me go through the portfolio review really quick. So we made a few changes actually here. So we had what I would call an experimental position in Sartorius Stadium. We had a 60 basis point of position in Sartorius Stadium, which is basically a bioprocessing equipment manufacturer based out of Europe. They're one of the major 4 players. We like the business. I mean, biopharma or bioprocessing is a kind of nascent industry, decent growth rate, 10-15% of industry growth. And these guys are kind of oligopoly in some of the equipment, some of the parts of the value chain. The reason we sold it off were kind of twofold. Number one, what you notice is that the next leg of growth in bioprocessing or in what they're doing would come from cell and gene therapy, and the mode of operation, the mode of expanding into those businesses through acquisitions. Now, when you did some analysis on the M&A of what Sartorius Stadium did over last few years, like especially the last one they did, the name is Polyplus. They paid around 32 times price to sales multiple to buy a company called Polyplus, as I mentioned. So $3.2 billion, that seemed, quite excessive. And even though it is strategic point of view, it might be good. But at the same time, our thought process was that, eventually they have to compete with larger players like Danaher, Thermo Fisher to get access to this part of the market. And if you are competing with these guys who have a very well-defined M&A framework for their company, I mean, that's how they've been built, then it might be very difficult for Sartorius to grow from here. So they might have to shed out a lot more money that they would like to. And the second thing was, there is a chance of ownership change in 2028 for Securities. There's a 30-year clause that restricted them to do any ownership change. But 2028, if that is the time frame, 2028, 29, then they might be incorrectly incentivized to go for this big lot size acquisition, which might not be that value accretive. So seeing these two things, we thought about taking out that position from our portfolio, and that was one. Then we trimmed our position in armies a little bit. The reason is very simple. Armies typically tends to grow in longer term at 14-15% revenue CAGR. And in last 2 to 3 years after COVID, they have seen a boom, massive boom, and they have been growing at 25 to 30%. So there will be some kind of normalization typically that takes place. And it has been a very good stock for us, to be fair. So we thought about, in September, we thought about taking some money out of it. And we thought about deploying it back to Berkshire Hathaway and Amazon. The reason Berkshire Hathaway is very simple. We have a defensive tilt to the portfolio at this point of time, and Berkshire gives you that balance. And for Amazon, I would say it is more Amazon. It is more about many of their actually the segments are turning around. Last year was kind of they faced very difficult comparables with the COVID year in the e-commerce segment, as well as this year they are facing quite a bit of headwind because their AWS business is tied to startups, and that AWS business is seeing some slowdown. Now, if that probably ends somewhere in next 2-3 quarters, we don't know the exact timing. We cannot guess that, but there's a higher chance that that will normalize on the upside. So if that does, then there's a good chance that the stock would outperform. So those are the basic changes that we did, and this is what the portfolio performance looks like. Again, we're just going to anniversary this month. So that's pretty much from our side, Nitesh.
Sure. I will request everyone on the call, if you have any query, please type it on the Q&A box. It's at the bottom of your screen, and we will try to address as many as possible. Arindam, there is one query on Berkshire. Given the age of Mr. Buffett and Mr. Munger, how do you see the succession risk? How do you look at it?
Yeah, we do. I mean, we have penalized it heavily in like we're discussing about how do you tackle the succession risk, and we have definitely penalized very heavily on the key man risk if something happens to them. But at the same time, you cannot really deny the underlying solidity of each of the business that they own, right? If you look at the railroads or the Geico or their big value coming from Apple Holdings, we have kind of faith in those. And the stock is trading at a reasonable multiple, 1.2 times price to book. So if we feel that of course these things cannot be discounted fully, but at this point of time we're actually fine with taking up the position a little bit.
Got it. There is one query from Mr. Sunil. I think Indian INR denominated returns has effect of currency appreciation or depreciation. So I think the difference between USD and INR denominated, I think that's what he's trying to ask.
Yes, it is. It captures that. And last 1 year since we have launched, thankfully, I mean, the INR has actually held up reasonably well. So the difference is not huge. Typically, you see 3 to 4% of difference, but that has not been the case last year.
Sajid has a query on the difference, in a sense, how do we select GCP and CCP? Is there any difference in terms of parameters? For example, he's asking in CCP, we talk of ROCE, whereas over here you talk of ROIC. So why the difference, and is there any other difference between GCP and CCP?
Yeah, so the selection, I would say, is a little bit different in the sense we are more focused on cash return on invested capital, that sort of things. For example, like an Amazon kind of company who tends to invest heavily. So they are actually, the profits have been negative for a long time, but they have been making like CFO, like cash flow from operations has been positive for them for a very long period of time. Now, CFO in our view, for example, or the EBITDA captures, for us, I mean, for GCP, probably a reasonable good version of, like how efficient they are in deploying capital. So we have different thresholds for sure. And also, there are minor tweaks here and there. If you think about from very top view, it looks very similar. There is no denial. But if you looking it from bottom up, there are certain differences just to make sure that the geographies are different. The operating environment is different. Now talking about ROCE and ROIC, look, I mean, ROCE is more, if you want to assess the efficiency of a company internally, ROCE is a great metric. If you want to assess a company externally for investment perspective, ROIC is a better metric. Okay, so choices. So we chose ROIC for that particular matter. Many of our companies are actually, they deploy quite a bit of capital externally, like M&A, etc. Whereas in most of the Indian companies, they tend to do most of the things organic. So, in that sense, we think that ROIC is probably a better metric for the GCP construct.
Got it. So basically, broad philosophy remains the same, Sajid ji. But yes, there are a few tweaks here and there because we can't have same parameters for different geographies. Global compounders are more matured, economy compared to India. In fact, there is a question on, you have touched upon a little bit, but there is a question on Amazon. If you can again, discuss. PNL, they have been making loss for a quite long time. Why have you decided to invest in Amazon in now? What brings it in the portfolio?
JB, you want to take it?
So there's a couple of things to understand about Amazon. So Amazon is a bit unique in the sense that they're the only company which explicitly runs for free cash flow. So they don't do anything from a P&L orientation. Everything is from a free cash flow orientation, and even they're a long-term free cash flow orientation. So which is why, because they don't care about their P&L, they only care about their cash generation. So the same sort of volatility that you see, or the extended periods of losses that you see in Amazon's P&L doesn't really show up in cash flow. The second thing is, and this is a company which is quite unique in the sense that they've managed to seed multiple large businesses within one organization over time. If you think of, started off as an online retailer, built a Kindle business, built an AWS business, built a logistics business, built an advertising business, built a video streaming business. And all of these stand on their own. All of them have been built internationally in multiple geographies. The culture and the practices which underpin that make Amazon quite unique in our view. And that's why we're comfortable sort of ignoring P&L volatility in a company like this, because we have confidence in the how of in how they do things, and comfort that over time that will continue to translate into cash flow delivery.
Fair enough, Javi. Request participants, if you have any query, please feel free to type on the Q&A box, and we will pick it up. There is one query on the operational part, how one can invest in GCP. So basically, GCP is through Gift City, and it's basically an Indian resident who wants to invest. Every year, Indian government allows an Indian to invest up to $250,000 per person. And through Gift City, we will open your Demat account. Demat account will be in your name. Shares will be held in your name. Once we open your account with Interactive Brokers, you will transfer, and minimum is $150,000. That's a Gift City rule. So you transfer $150,000 and there is a TCS of 20%, basically 30,000 extra. Bank will deduct and they will deposit against your name as advance tax, which you can claim, as a set off while filing your returns or during quarterly, advance tax returns. You can claim set off, and then we invest that money in your name in US and European stocks. And you will have online access and you can check everything online. If you have any further queries, please feel free to write us on invest@marcellus.in. And I think there is a question on taxation as well. So taxation is same as that of unlisted companies. If you invest in unlisted, the taxation over there and over here it's same. So long-term capital gain is 20%, subject to you stay invested for 2 years and more. If you sell or there is a churn in the portfolio before 2 years, then it will be the taxation will be at the marginal tax rate. And dividend will be charged as per the marginal tax rate. So whatever dividend, and there's a TD tax deducted and in US that you can claim set off, and the dividend will be charged as per the marginal tax rate. But in our case, churn will be pretty low. Idea is not to churn the portfolio too much. So hopefully most of the gains would be long-term in nature. If anyone has any queries, please type. We'll just wait for another 20 seconds. Yeah, we have a query from Shalini. Is GCP focused only on US markets? So I think around 80% is in US, balance is in developed Europe. And I think broadly it will be same. Anindam, correct me if I'm wrong.
No, you're right. Yeah, 75%. Yeah, that will be in the US, and the rest balance will be Canada plus developed Europe.
And also she has a she's asking for views on US going forward. Anindam, if you want to share anything, but honestly, we don't have any view. In equity market, you have to be a long-term investor. If you are investing for long-term, then it makes sense. Short-term, it's very difficult to predict what's going to happen. But Arindam, anything, Javid, anything you want to add?
No, I echo what you said. Macro view, there are certainly some problems around everywhere, actually, not only in the US. But again, timing these things are hard, and you don't want to do that because you cannot do that. In longer term, we are kind of confident that the US market can give you the returns that they have done in the last 60, 65, 70 years. There has been many cycles, ups and downs, but if you had, held through different time frame, you have made good money. So even at this point of time, I think that is quite possible. If you're taking a 5 to 10 year view, that doesn't change.
Absolutely, as Warren Buffett says, timing is not important. Time spent in the market is important. So if you have a horizon of 5 years, then it makes sense, to invest. Mr. Shankar has a query on treatment for NRI on taxes. So Shankarji, there is if your taxation will be as per your jurisdiction. So suppose if you are based out of Middle East, whatever is the taxation on long-term, short-term, it will be as per your tax treatment in Middle East. In GIFT City, there will be no tax deducted. It's all passed through. It will everything go back to you. And whatever is the tax rules in the place where you are based out of, it will be as per that. Shekhar has a query. If profit booking is not repatriated, even then tax has to be paid. So again, it all depends in which tax jurisdiction you are. If you are based out of India and there is a churn in the portfolio and there is a long-term gain, then even if it is not repatriated, you will have to disclose and you will have to pay. If you are based out of, if you are an NRI, then it will be as per the rules and regulations of the country where you are based out of. Vivek has a query. Is GCP also looking at diversifying beyond US and Europe to markets such as Japan, which are showing some revival movements? So Arindam, Javi, any thoughts on it?
Look, I mean, we do run our screener at different geographies, but to be fair, I mean, we have been concerned about the capital allocation practices of Japanese companies. What I have seen is that, similar company, what they are doing in Japan, if something we find, like, if it is very interesting, we find something in US or, preferably US, I mean, that actually, they tend to be much better capital deployer. And capital deployment is a kind of key thing for what we do here. So in that sense, I mean, I understand the value rallies. There's some activism going on, in last 4 or 5 years. Japanese market have actually done pretty well in last 6 or 7 years. They have an Abenomics and all that stuff. But on the fundamental, long-term compounding, we are probably not going to touch it in near term. That is for sure, because we're not confident about their long-term capital allocation. The construct is very different from what we look for.
Thank you, Arindam. There's a query on how can NRI invest. So we will open, I will request if you can please drop us an email, invest@marcellus.in. You can CC me in Nitesh, NITESH@marcellus.in, and we will reach out and share you details of how you can invest. Basically, we will open your demat account with Interactive Brokers in Gift City. And you will transfer money in dollars. That money will be deployed in dollars in US and European stocks in your name. It's pretty seamless process, but we will need some data. There are some small requirements basis the jurisdiction where you are based out of. So if you can just drop us an email, we will reach out to you. invest@marcellus.in, and please CC me Nitesh@marcellus.in. Shekharji has a query. Is there any investment in Australian stocks? No, there is no investment in Australian stocks as of now. Yashovardhanji has a query, Arindam. If possible, can you share the slide on major holdings or how the portfolio is constructed with US and European stocks? So, if you can give some broad numbers and some few stock samples, that we have.
Yeah, so we have around 28 stocks in the portfolio now. So, I mean, if you're following our webinar, we have kind of, laid out probably most of the names are right now known. So among the big seven, the magnificent seven that people talk about, we have Amazon, Apple, and Microsoft, which are around 10% of the portfolio. Other than that, our biggest holding at this point of time is Berkshire Hathaway, followed by Costco and Heiko, and Constellation Software, and then that is followed by Copart. So this constitutes around 50% of the portfolio. And there are a few other big holdings that we have. There's an industrial company, Ametek, and what is let's call it a name. Ametek is, that's another big one that we have. So yeah, I'd say those are the 56% of the portfolio that we have. And Danaher, sorry, I forgot that. Danaher is another big one. So that is around 60% of the portfolio, that top 8 to 10 stocks that we have.
So again, I think it's a deep research, bottom-up driven approach, and it's not the usual FANG kind of story. Total, I think, tech IT based investment is around 20-odd%. So there is a whole host of companies across US and European stocks, that is part of the portfolio. So Shankarji has a query. Is the portfolio same for all GCP investors irrespective of point or date of entry?
Yeah, so we tend to maintain a model portfolio, which we do every month, and that typically doesn't change. Now, if suppose you entered some point of time and some of your stocks ran up quite high, So you have tolerance band defined for each stock. So it is not that you'll be rebalancing your portfolio like, as per the model portfolio every month. That will actually basically induce churn, which you do not want to do. But the model portfolio is what the new entrant would get. So if you are an existing investor, your portfolio might look slightly different from someone who is joining new, but it will not be drastically different.
So just to elaborate, suppose a stock X has 5% allocation in model portfolio. You invested today, and another invest 3 months down the lane. Because of rally in your portfolio, in investor one portfolio, 5% became 7%. Whereas when a new investor enters and subject to the company continues to remain in model portfolio, he will enter with allocation of 5%. And if the fund manager believes the stock doesn't have any juice left, fundamentally it's not strong enough for us to remain invested, then it will be removed from model portfolio, or weightages will be reduced, and that will be replicated across all investors, whether new or old. It doesn't matter. The changes will be made across all the investors. Please feel free to type your queries. Model portfolio disclosed to investors? No, model portfolio is not disclosed to investors. But as Arindam mentioned, if you follow our webinars, you will pretty much get to know most of our holdings, because we always believe it's not companies that are the secret sauce. The reason why we end up investing and holding them is the secret sauce. All our webinars, newsletters are available on our website. You can spend time, listen to it, read through it, and pretty much you will get to know 70-80% of the portfolio, or at least the names you will get to know. I think we'll just wait for another couple of seconds. If there is no more queries, we will close the webinar. But again, if anyone has any query, please feel free to reach out to us. We will be more than happy to get back to you and answer all your queries. I think we don't have any more queries. Thank you so much, ladies and gentlemen. Thank you, Arindam. Thank you, Jabir. We look forward to hosting you again in the next Global Compounders webinar. Thank you so much.
Thank you.